Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, June 28th, 2016. This is a midday update. It's 10:37 a.m. Eastern Time as I'm starting this video, so the trading's well underway. We're coming up to the lunch hour here, and I figured we'd take a quick look at the markets. The three main indexes that I follow: the Qs, the SPY, and the IWM. If any of you trade the mid caps, I know there's a couple out there, let me know and I'll be glad to put up some static charts or incorporate those a little bit more into my analysis. But let's go ahead and dig into the charts here, and we'll start out with the QQQ daily chart, which we're on right now. So as far as levels go, this 104.40 was recently mentioned as a key support level. Numerous reactions, as you can see there from above, reactions from below, gaps, and it goes back quite a way. So that was a pretty significant resistance level, which we gapped below yesterday, and we're still below today. In fact, we back tested or made a near back test to that level from above. In fact, when I get to the 60-minute charts, you'll see the Qs, which most of you know, it's the index that I put probably the most emphasis on since it's been the leading index for years now. So the Qs today made a significant back test of yesterday's gap, backfill and reverse so far, and the SPY and the mid small caps have yet to do so. So as far as levels I'm watching for the near term, let's watch this 104.40, see if the markets can regain that level or not. Obviously, it would be bullish. It doesn't, when a technical event is bullish or bearish, that doesn't mean it's an all or none thing. That doesn't mean that all of a sudden the entire long-term, intermediate term technical picture changes from bearish to bullish if 104.40 is regained. But it would be the first, in a series of potential steps that start to chip away at the bearish scenario and help at least the near term and possibly the longer term bullish case. Now, in the longer term bullish case, we really have to take out this downtrend line as well as the downtrend line on the SPY and everything else that we recently failed. The markets failed trying to recover. So we're right now, the long-term technical picture really isn't even into play here. We are at a critical technical juncture. Let's see what happens in the near term. Again, let's see if this 104.40 level holds or fails. The market fails to regain it on a back test, especially a closing basis. Closing basis on a daily chart is much more important. It's really all that matters when trading on the daily time frame. And we'll dig down and look at the intermediate time frame in a second here. Looking at the 60-minute chart, but the levels that I'm watching beyond that, I've modified these support levels. I had the old support levels from way back here during this correction. This was, I think, the former support S1 zone. I can't recall, but I've changed these. Right now, this is the first key support zone, these two horizontal lines. When I have two horizontal support levels in close proximity, I refer to that as a support zone. So there's the S1 zone that comes in. The top of that's around 99.50 or so. You can see here it was resistance back here in 2014, late 2014, early 2015, numerous reactions from above. We had that sort of flash crash in the Qs there, and prices whipped back up, and this is where trading normalized, and that level was tested again. So, and you can go back through here and you can see some reactions and gaps. So either way, I think that's a pretty important support level. If the markets start to move lower, something to watch, a level maybe to cover your shorts. I don't know. I can't tell you right now what type of reaction I'd expect if and when we get there, because I need to see what happens, in the next few days here. And if and when that goes, this S2 zone is a pretty significant level. You can see the reaction lows back here from earlier this year during that sell-off. That candlestick normalized. Remember, this long wick, or I should say shadow or tail on that candlestick, that was very brief after the open. And again, there was a mini crash in the Qs that didn't correlate with the action in the NDX. So that's almost what I call an erroneous spike, if you will. This is where trading normalized that morning shortly after the open. That's also where that gap was. And again, that reaction. So S2 zone is a very critical level. And I'll tell you right now, if and when we get there and the S2 level cracks, S2 zone, I think it's very safe to say that the bear market, that the case has been laid that we're in a new bear market at that point. That'll mean a knife through the bulls' hearts and really just completely shut the door on any on the bullish case, market going to new highs, the bull market continuing, the fact that this was only a correction in an ongoing great secular bull market. Again, if and when that S2 level goes, and goes with conviction, of course, not just a intraday break and a whip back above. Those kind of, especially during momentum sell-offs. Just keep that in mind, folks. When we have these what I call Momo-fueled sell-offs, momentum-fueled, quick, impulsive moves down, like we had here. These are impulsive moves. It is more than common, if you will, to get an overshoot of a key support level. So let's say the markets start waterfall selling off later this week or next week and shoot down through here, especially down that S2 level. Intraday, you want to see a close or a very impulsive move. When you get down there and it's going on 3 o'clock with an hour to trading, and if we're trading well below the S2 zone and it looks and there's not anything reflected in the short-term charts that show we'll probably bounce into the close, then it's safe to say that level is gone, especially if we print a solid close below. So that's how I treat these support and resistance levels. Again, in these very fast-moving markets, whether it's support or resistance, it's not uncommon to see a brief overshoot, especially an intraday overshoot of those levels as long as trading closes. And that's what when you look back at this level here, you see these candlestick shadows right there, the tails, and those were intraday pierces, and then like a magnet, prices close back up on that support level there. So let's go ahead and look at the 60-minute charts and see what we have here. Okay, I put a couple of 60-minute charts up this morning on both the SPY and the Qs. These are levels to watch. Let's zoom in. This is yesterday's gap. There's Monday's action right here, Monday's price action on the 60-minute chart. So this was the bottom of the gap right there when I hold that crosshair around 104.08. And you can see so far the Qs, again, in my opinion, the most important index, but it's very important that I say that I take everything into account. If I'm trading, even if I'm only trading the Qs, I'm going to watch the SPY. To a lesser extent, I'll watch the mid and the small caps as well, but mainly watch the SPY as well. For example, the Qs were rejected so far off this gap, but let's say the SPYs right now were doing well. The SPY backfilled the gap and was starting to move higher and taking out resistance levels. Then I might be a little more hesitant to short a backfill of that gap or a failure at the backfill. But I wanted to point that out. So far, we had a backfill the gap, which may be it. And we'll know soon here, especially towards the close today. Again, volatility's high. Don't get too crazy with your positions. But as far as objective shorting levels, we failed so far on the back test. We're not far from it now. I gave a bounce zone, right here around 104.48 up to this level where I think it would be objective to add. We didn't even make it that far yet. And, if we start rolling over towards the close, I would just hold off in the next day or two. I'll tell you what, if you're already short, no reason not to sit tight right now and just see what happens in the next couple days here. In other words, let the dust settle from this big move down and see where we go. I can tell you this right now. Any move below yesterday's lows, that's around 107.78, that would be quite bearish. And again, if we come back up, backfill the gap, and start moving higher, I think this is an ideal shorting area up in here. And you could set your stops. You can see these levels here, that 106.30, that's resistance. And I also had another level there on the chart I posted this morning. Numerous reactions there. That level is at 107.20. Short here, stop there. Again, it's hard for me to say because everybody has different time frames. Some people like to just get a 2-3% move down the market and cover, while others might be positioning for these trades. This is what I'm really referring to. This is the mode I'm in. I'm in swing trade mode. And yes, do I micromanage my positions like covering yesterday, reducing some short exposure as we hit support? Yes, that's what I did. And scale back a little bit today, but I'd like to see us push a little higher and before adding much more. And let me get to the SPY and I'll look at those levels there for you real quick. So anyways, that's the Qs. Let's move into the SPY. Here are some levels to watch. This 199.85, that's about where trading normalized yesterday. You can see here on that candlestick. There's quite a few reactions back here, reactions from above, reactions from below. So I think that's a pretty important level. We pierced through it intraday, but managed to close right back up above it or right on it. Where did we close yesterday? Let's see, 199.60. So just a hair above, just a hair below that level. And so far we're bouncing up. I'll get to the 60-minute charts in a second, but you can see this is that 203 is a level I pointed out before is a very important support level, and that broke, that we gapped down below that yesterday. So there's 203 defined by a lot of reactions. You go back here, here's a big gap, reactions from above, reactions from below, and that would be in a very objective shorting level, if and when. And I like to also short just in front of a bounce back to resistance. The same way as, when when I have a profit target, if I was long, let's say the SPY heading up in here, and 203 was where I saw the resistance level at, I'm not going to set my sell limit order at 203. That's not where I want to take profits. I want to take profits at 299. 299, I'm sorry, what am I saying? 202.95 or something like that. Just shy, maybe 5-8 cents shy. And it all depends on the price. If you're on a $203 security, 10 cents is easily, a minimum buffer, 10 cents, if not more. But if that was a $20 stock, then I might just be talking a few pennies shy of it. If it was, $20, I might take profits at $19.95 a share or something like that. And I do that because if all eyes are watching 203, let's say you want to short the backfill of this gap at 203. There is the reaction low is a little bit lower than that. The low was 202.72. So, okay, let's say you want to short that backfill at 202.72 right there. Then you don't wait for 202.72 to short it, because if that level is going to fill, let's say everyone's watching the SPY and that's where the traders step in to short the gap backfill, there's a good chance they're going to step in early and it might reverse early. Another thing I wanted to point out, I'm kind of going off on some tangents here, if the market is in the phase that I think it might be, which is the next big leg down in a sell-off or a correction, or whether you want to say next big leg down in a bear market, and we get this impulsive selling, it's already started. Undoubtedly, this has been impulsive selling. Let's just highlight that. Take a look at something here. All right, so we have this impulsive selling here so far. We had impulsive selling here, and what happens in these meltdowns, it's just getting started. When we get these impulsive moves down, and it's been building for a long time, you tend to get these waterfall sell-offs, and bounces are sold into rather quickly. So let's say you're a Fibonacci trader, and in a normal trending market, you want to, you'll give yourself, let's say you're looking for a retracement to add short exposure. And you might look for a 50 or even 61.8 retracement on the fib. In this case, you want to look to the lower end of the retracements, maybe even a retracement that might even fall shy of the 38.2 retracement. Or in this case, if you're not talking about fibs, let's say, well, minimum retracement here, would look healthy, and objective short entry would be 203. We might fall shy of that, and so far we have fallen shy of that. And if so, if the market is in one of these stages here, very impulsive selling like this, if it's another repeat of this period or something like this, or even worse, we still haven't had anything even close to 2000, 2008. I'm sorry, 2007, 2000, especially some of the moves down in 2008. And I don't see that happening right now. I don't think Brexit is that big a deal. I can definitely see some potential repercussions on the financial system, especially with the European banks. But and we'll watch that and be ready for it. That's part of trading. I had this shorting zone. Let's go over to the 60-minute chart. Before I do, I'll just cover these levels. 195.09-ish. So call it 195. That looks like very nice support in the SPY. That might correlate with that support on the Qs. And as I mentioned, how I always keep especially the major large cap indices on my radar at any point in time. If the Qs fall to one of my key support levels, I'm watching the SPY as well. So let's just say, for example, the Qs fall and break slightly below their support, but yet the SPY is coming up on that support. I might hold off adding any short exposure on the Qs because maybe the SPY reverses. So what I like to do, in other words, is see both of those two indices, the SPY and the Q, and ideally, if you can see the mid caps and the small caps all break support, that greatly increases the chance that that support level is broken and prices will continue lower versus versus a reversal or a intraday break like I talked about, a whipsaw sell signal, especially during these momentum fueled markets. So again, it's safe to see, and you'll notice this, that more often than not, as the markets move down, the same levels that I have on the SPY will correlate to other levels on the IWM, the small caps, the mid caps, the NASDAQ, and all that. So we watch them all together, and if and when all these levels start to crack, then obviously my expectation is for a move down to the next level. Now, whether we go straight there or we come in and back test it, that all depends on how the intraday charts look at the time. But right now, the technical picture is for swing trading, if you're not into trying to game these intraday bounces, the big picture is bearish right now. We broke down from this ascending broadening wedge pattern after that failed breakout, the divergent high. You can see the MACD right now. As most of you know, I like to use a very simple but effective trend indicator. Is the MACD, the 9 EMA, which is a signal line, the white line here, when that is above the zero line, this dotted line, the trend is bullish, as it has been since this point right here when it crossed over. And as you can see now, the MACD is clearly pointed lower. The MACD line's crossed below. That's that negative 1.21 value, but the signal line's right on the zero line. And keep in mind, that's not an all or none. Short the market hard as soon as that zero line crosses, or go long as soon as it crosses back above. But you can see, looking back historically, it's done a very, very good job of defining uptrends. Kept you long all through here. Here's a clear cross down below with that white line. There was a bearish trend above. I've covered this many times, but just something to look at that just strengthens the bearish case. Now, if I saw the lines, the MACD pinching and curling up at this point like it was here, looked like it was going to make a kiss and roll back over, and that's possible. The market, if it reverses hard right now, takes out this 203 level. Those are the things I'm looking for to really strengthen the bullish case, or at least cause me to step back, maybe reduce some short exposure, hedge up a little more. Would be a solid move back above 203. All these gaps to be filled: the IWM, the Qs, the NASDAQ Composite. See these MACD trend indicators remain bearish. I'm not concerned about oversold. Oversold can become a lot more oversold. So yes, the RSI, and it actually, we never even hit the 30 level. So we never even became technically oversold yet, at least not on this indicator. So that's where we're at. Now we get down to the 60-minute charts, and here's what I pointed out earlier. These are support and resistance levels. This 201.60, that's basically the bottom of yesterday's gap right there. There, the top. I like to use the lowest point, call it 202.70, but I had a horizontal. There's that 203 level I watched, which was important. But as you can see here, if we zoom in, let's go ahead and do that. There's the top of the gap, the lowest point of Friday's candlestick, and the SPY so far. This is pretty weak behavior. Yeah, okay, it was up today. It was up a little higher, but we're only up 1%, and that's after a big drop. And so far, the SPY hasn't even had enough to backfill the gap. And that wasn't a very big stretch to get up and backfill that gap. If there was right now, and one day doesn't make a trend, but if we had a lot more buyers and sellers in this market, and Brexit was just a passing thing, an overreaction, you would expect at least to backfill that gap, and then maybe a pullback, and then power back up. But right now, I'm not going to say that it's bearish, that we didn't, because we haven't failed at backtesting yet. We're still in the gap. See what's happened today? See these 60-minute candlesticks? Look at this. Each and every one so far is right there. The bodies, that's most important. The bodies are within that gap range right there between these two lines. And so we're holding on that 201.60 level. We've had a few intraday pullbacks below, but we haven't closed below it yet. Close. We're at 201.77 right now. You can see we're dancing on that level. So if we move back in there, and then again, ultimately, to really say that this battle has been won by the bears, so to speak, will be a move below yesterday's lows. Call it 198.70-ish. That's all trading is. It's a series, just like in a war. you have battles within that war, and these are little battles. So if the bears want to win this battle, they need to take out that level. The bulls can win this battle, backfill that gap, and then move up above it, 203. There's still resistance above. They have work to do, but each resistance level they take out, they've won a battle. And you win enough battles, you win the war. The war would be to break out the market to new highs, and then at that point, whatever, the markets continue on. I don't want to get too far carried away with that analogy, but that's just what I'm looking at right now. So near term, I'm trying to watch this battle between bulls and bears, and what that does, it gives me an idea of the supply dynamics in this market. You know, right now, are there more sellers? Does this market still have a strong bid underneath it as it has, you know, in the last couple months? Or has that bid dried up, and are we now at a point where there are more willing sellers in the market than willing buyers? And we'll know if we start to drift back below, can't hold that 201.60 level today, move back down, and especially down below the 198.70 level. Okay, that's the SPY, and we'll take a quick look at the IWM, and I'll wrap this up. Let's go back to the daily chart. We'll start there. This was that last very steep uptrend line. In fact, a couple weeks back, I did a video solely dedicated to the IWM because I wanted to talk about this. I've seen this before in the markets. I saw it back here, and over the years, I've seen this many times where you have a very clear bearish, or on the flip side, bullish pattern. In this case, it was a bearish pattern, broke down, started playing out, and you had this what I call a WTF ramp, what the fudge, or whatever you want to call it, where it's almost an unnatural buying spree. It was in low volume, and we saw it particularly pronounced in the small caps, but that was a very steep uptrend line, put in a divergent high, broke down, and I mentioned that at the time. There was your sell signal. Once we broke down, you can see the impulsive selling so far. So far, so good. These are all support levels. So basically, if you were in the trading room yesterday, I pointed out that this was a pretty solid support level. And it was a retracement of that entire rip up. So that's where I had closed out the IWM shorts that I had, the small cap shorts, TNA, just to take some profits because I expected a bounce. Even if we melted down lower, the risk to reward to remaining long at that point just isn't very favorable. So we've had a bounce so far. We're off the highs today, but that's about 1.5%. And I did recycle back into some shorts, but not the small caps yet, and I may do that soon. Still undecided, but I want to look at these levels. This should be right here. That's resistance, would be yesterday's highs. And let's dig down into the 60-minute charts. Before I leave here, I'll just point out these other levels. So that's 105.66 and 102.49. So if and when this level goes, to be safe, say yesterday's lows right there, which were around 108.25. That's your support to watch. So the battle for IWM, the bears need to take out that 108.25 level. Bulls obviously first take out yesterday's highs. And let's zoom down to the 60-minute chart, and we'll wrap it up there. All right, here's what the 60-minute chart looks like. There's yesterday's highs, 111.05 roughly. That's where I put the line. We'll have to hit that candlestick high, 111.07. So we'll fix that. 111.07. I mean, it's so far. This is showing weakness in the small caps. As I showed you, the Qs made a full backfill of their gap, whereas the IWM has not even entered yesterday's gap yet. In fact, it's fallen short of it in reverse. So that's weakness in the small cap so far. And if it does get up into the gap, you're going to have resistance here. Well, you have Friday's low right there, around 111.50-ish. We had this pretty key level I've had here for a while, 111.80. In fact, I've had that line. I haven't updated that line, you can see, since May 16th. There's probably a lot to the left of this chart you don't even see, but I had that colored, and that usually means that line stood out to me. So I think that was a very key level. And it was a key level because we gapped below it yesterday. And so even if we do backfill the gap, let's see if we take out the 111.80 level. I think any bounce up to even to yesterday's highs, that 111.07 all the way up to 111.80, excuse me, is a very objective level to short. And if it goes, now what happens? You don't have to stop out right away, especially if you are swing trading this thing and you're looking to add short exposure for a move down to these levels. In my opinion, a stop just above that 111.80 would be too tight. However, what I do in trading is I'm not going to add at that point. If I do add between 111.07 or even decide today to add back some exposure, I may continue to add up to 111.80, but I will not continue to add beyond that, because at that point, if we're heading lower, I don't think the market has any business getting much above there. Again, it doesn't completely destroy the bearish case, and that's why I wouldn't stop out. My stops, I'd be more concerned about these levels up here. Let's see what this is. That's 113.34, that line. I have a level here, 114.14. So in other words, you don't want to keep digging in a hole. Some traders will only add to a winning position. They say never average down. I'll average down, but only if I plan to do so already. I never average down on a losing position for the sake of lowering my cost basis. That doesn't make sense. But if my trading plan says scale in, scale short up to this level, but then hold off if we go above there because something's not right, we may be going higher. And then the stops would be above that. And I'll update you if and when that time comes, I'll update it. So those are my thoughts right now. And, until we either break above 111.80 or break down below, let's move that line up a little bit, about 108.15 or so. This is anybody's game. I think the breakout will occur to the downside. I'm looking at a lot of things here. I'm looking at the intraday charts. A lot of you know that, when swing trading, I've talked about this a lot, but I know there's a lot of new people coming into the site all the time. When swing trading, let's look at the SPY. I look for these divergences on the daily time frame, bullish or bearish divergences. In this case, we had a divergent high. This tells me be on the lookout for a trend reversal in the market, a tradable trend reversal that can last weeks, usually months, when you have divergences on the daily time frame. Again, bullish or bearish. This chart doesn't show them all, but I've done that in the past, gone over all the divergences. All of them have played out for trend reversals. So that put me on to swing trade, short side kind of mentality, weeks and most likely months. Now, when we get those signals, and now it's been confirmed, the divergent high in itself isn't a buy alone sell signal, but it is, okay, at this point you want to start getting short. Now confirmation has come with the breakdown in this pattern, the ascending broadening wedge pattern, break of support, impulsive selling, blah, blah, blah. A lot of additional information has now confirmed that we've had a trend reversal, that this uptrend is over. That's what I'm trying to say. And based on the scope of these daily divergences, I don't think this move down just in the last couple weeks is commensurate with what the charts are projecting. In other words, I'm looking for much more downside. You can say, well, that was just Brexit. You got lucky. The Brexit vote went the wrong way. I'm a firm believer that was all priced into the markets, and whether Brexit vote passed, didn't pass, maybe the fact that it didn't, maybe the fact that it passed was already priced in here, reflected in the market action. Who knows? I don't care. You can't second guess this stuff all day long. Trade off the charts, and right now the charts are clearly bearish. And where I was going with that is when I take a position, long or short, or at least a bias, now that the trend is down, what I look for, and it's not my be-all, end-all, but I like to see 60-minute divergence, bullish divergence. So if you ask me what's going to happen here at this point, see the MACD, not even close. We don't have any divergence. If I can draw it out here for you, I will. Let's see if I can do that. Give me just a sec. Okay, let me draw out what I'm looking for, and I don't expect this to even happen right now, or at least not in the next couple days here. But at some point, you see the MACD. Okay, the MACD has made a reaction low here. It went down, it curled up, and it's made a bullish crossover. So one thing that would put me on guard to reverse from a net short to a net long position would be another higher low in the MACD. In other words, like that. Same with the RSI. We see a higher low in the RSI, and you can do the same on my trend indicator here. While the market goes on, let's draw it out. Market drops down, prices make a lower low, and then of course we have, I'll just use the arrow tool, just imagine these are lines, we have positive divergence, and That's, again, these I use arrow tools. I didn't want to click. I didn't have a line tool handy. So that's what I'm showing you. Price is making another thrust down, at which point when I see bullish divergence on the 60-minute time frame, as I did here, many times in the past, I pointed those out at the lows that we had earlier in this year when the market had the big meltdown. Those are the heads up that you now have a tradable bounce that's likely to last more than just a few hours or a couple days, like the one so far that we've had today. So right now I don't see anything in the 60-minute charts remotely close to telling me, cover all your shorts, hedge up fully, or go to a net long position. I see my trend indicators solidly bearish. I don't see anything in the 60-minute charts, and so for now I'm more concerned with where to add back short exposure than to stop out of my positions or look to flip to a net long bias. Okay, this has been Randy Finney with the right side of the chart. Hope you enjoyed it.